Yes, of course, the first quarter has been a very volatile economic backdrop and geopolitical backdrop, given the devastating events happening in the Ukraine and the impact, obviously, that we see of inflation on capital markets and a lot of volatility that we see in the equity markets. But in spite of all that, we're posting today a very solid set of results, which is basically a proof testament to all the hard work that we've done over the last 2 years to improve the risk profile of Aegon. And today, a solid set of results, profits dynamics up, growth dynamics still in good place, and a rock-solid balance sheet and solid solvency positions.
Can I just pick up on one of the comments, too, in the statement about a non-economic loss on interest rate hedges? We know it's been a fascinating environment with rates going up fairly rapidly and taking a lot of investors by surprise. Just walk us through some of those hedges and now how you're positioning around a high rate environment.
Yes, we have a lot of hedges and derivatives in place to ensure that we protect our solvency position. And while they come with some accounting noise, which you're seeing coming through in the fair value items today, they are there to protect the solvency ratios of the company. And look at them this quarter. They're rock solid. And when it comes to, let's say, the hedges that we have in place for the variable annuity book in the U.S., those hedges have demonstrated to be very effective, with a hedge effectiveness of 97% this quarter.
Lard, can I ask you about inflation and interest rates? It's both critical factors for the insurance segment here. How under attack is margin at the moment, and are you reluctant to write some new business because it's just not profitable enough?
Yeah, thank you, Jeff. Inflation is well, very visible, of course, everywhere in the world. And we manage inflation risk very actively as a company. So in October last year, we put inflation hedges in place of the largest balance sheet that is potentially affected for that in the Netherlands. So we were in time to do that well. Secondly, we manage inflation in the U.S. by adjusting products and by, of course, continuing to be forward-leaning when it comes to expense reduction plans, because inflation obviously will have a headwind for our expense reduction objectives that we have. But our plans have received renewed focus. Our progress in expense reduction is good, so we are still confident that we are able to attain our objective of 400 million expense reduction by the end of next year. Now, when it comes to interest rates, so to the extent that inflation is followed by interest rates movements upwards, interest rates up are good for our industry and are good for Aegon in the medium and longer term. Don't forget, we are a very large institutional investor, which has to reinvest a lot of its business and its premiums every year. And if you can do that against higher rates, that is obviously positive for us. Secondly, higher rates also mean that embedded options and guarantees in our products are weighing less heavily on the balance sheet. So that's another positive element of it. And thirdly, higher interest rates make, in general, life insurance and the kind of annuity products that we sell and that we offer to our clients more attractive for our clients. So in that sense, rates up are good for the industry, for the life insurance industry, and are good for Aegon.
Not great.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.